The financial revolution of the digital age. What is money? Throughout history, answers to this question have included seashells, precious metals, paper banknotes, and digital numbers. But is a completely digital, encrypted, global value system, uncontrolled by any central authority, possible? In 2008, as the global financial system teetered on the brink of collapse, an unknown person or group offered a radical answer to the world. Its name was Bitcoin. What followed was a tumultuous, revolutionary, and highly controversial universe of thousands of digital assets we now call cryptocurrency. Could this digital gold rush fundamentally alter the basic principles of finance? Or is it merely a new tool for speculation and uncertainty? This is a story of technological genius, boundless ambition, and the struggle to redefine the future of money. For the traditional financial world, 2008 was a nightmare. The collapse of Lehman Brothers, bank bailouts, and a global crisis of confidence deeply shook faith in centralized financial institutions. It was precisely at this time, on October 31, 2008, that someone using the pseudonym Satoshi Nakamoto sent a 9-page technical document, white paper, titled Bitcoin, a peer-to-peer electronic cash system, to a cryptography mailing list. This manifesto proposed a solution to a fundamental problem. How can we securely transfer a digital asset between two parties without a trusted intermediary? Banks? Card companies? This was a technical hurdle known as the double spending problem. Satoshi's genius was proposing a revolutionary technology, blockchain, where previous digital currency attempts had failed. What is blockchain? Simply put, it is a distributed, encrypted digital ledger. Transactions are verified by thousands of computers, nodes, on the network and recorded in blocks, linked together in chronological order. This ledger is public, transparent, and immutable once recorded. This eliminates the need for a central record keeper. Trust is based on mathematics, cryptography, and consensus protocols among network participants. The process securing Bitcoin's blockchain was a system called proof of work, where miners expend computational power to solve complex mathematical puzzles. On January 3, 2009, Satoshi Nakamoto mined the Genesis block of the Bitcoin network. Encrypted within this block was that day's headline from the Times newspaper: Chancellor on brink of second bailout for banks. This was a clear declaration of Bitcoin's philosophical starting point. An alternative, a protest against the traditional financial system. The early years belonged to just a handful of cryptography enthusiasts and idealists. On May 22, 2010, a programmer named Laszlo Hanyecz ordered 2 pizzas for 10,000 Bitcoin. This was Bitcoin's first real-world purchase, celebrated today as Bitcoin Pizza Day. Those 10,000 Bitcoin are worth hundreds of millions of dollars today. This anecdote was an early sign of the extraordinary volatility and speculative potential of the crypto world. So how did this digital asset evolve from a toy for a few enthusiasts into a global phenomenon? As Bitcoin's value slowly increased, new projects sprouted based on its open source code. These were generally called altcoins, alternative coins. Each emerged claiming to overcome Bitcoin's limitations, transaction speed, privacy, energy consumption, or to offer different use cases. In 2011, privacy-focused Litecoin was introduced as the digital silver. In 2015, a young programmer named Vitalik Buterin launched Ethereum with a vision extending beyond Bitcoin's blockchain. Ethereum's revolutionary innovation was smart contracts, programs encoded on the blockchain that execute automatically when certain conditions are met. This enabled the building of decentralized applications, dApps, beyond money transfer, for finance, DeFi, gaming, digital identity systems, and much more. However, this rise had a dark side. Bitcoin early on became the currency of the dark web marketplace Silk Road, where illegal goods were sold. This created a lasting perception linking cryptocurrencies with crime, money laundering, and anonymity. The same period also saw exchange hacks and fraud. In 2014, one of the largest exchanges, Mt. Gox, collapsed after the theft of 850,000 Bitcoin, worth $450 million at the time. 2017 witnessed the crypto world's first true mass frenzy. Bitcoin's value, around $1,000 at the start of the year, soared to nearly $20,000 by December. Behind this bull market was institutional investor interest, and especially the explosion of initial coin offerings, ICOs, on Ethereum. ICOs were an unregulated crowdfunding method where companies raised investment for new crypto projects. Hundreds, even thousands of projects raised millions, often with just a white paper. Many failed or were exposed as frauds. But this frenzy brought the speculative potential and risks of cryptocurrencies to the forefront of mainstream media and public attention. This overheating inevitably led to a correction. The period beginning in 2018, known as the crypto winter, saw market valuations drop by over 80%. While many investors suffered heavy losses, a question remained. Were cryptocurrencies just a speculative bubble, or was this sharp decline laying the foundation for a more mature and sustainable industry? The crypto winter weeded out weak projects, but technological innovation continued. A new rising cycle starting in 2020 was based on different fundamentals this time: institutional adoption and the discovery of new use cases. Major companies and financial institutions began adding crypto assets to their balance sheets. Tesla accepted Bitcoin for vehicle purchases. Companies like MicroStrategy accumulated Bitcoin as a treasury asset. Wall Street giants began offering Bitcoin futures and exchange-traded funds, ETFs. This meant crypto was gaining legitimacy as an alternative asset class, moving away from being a marginal asset. During this period, the decentralized finance, DeFi ecosystem built on Ethereum exploded. DeFi promised to offer traditional banking services, lending, borrowing, earning interest, insurance, via blockchain and smart contracts, without intermediaries. Users could earn interest by placing crypto assets into liquidity pools. DeFi's total value locked TVL reached tens of billions of dollars, but systemic risks, security vulnerabilities, and hacks also exposed the fragility of this new field. In early 2021, the world was swept up in NFT non-fungible token mania. NFTs are tokens representing unique digital ownership on the blockchain. Artworks, collectible cards, music, and even tweets found buyers for millions of dollars. Beeple's digital collage everydays. The first 5,000 days sold for $69.3 million at Christie's auction house. NFTs offered artists a new revenue model and sparked a fresh debate about what ownership could mean in the digital world. However, this field was not immune to concerns about speculation, bubbles, and fraud. This rapid growth inevitably drew regulatory scrutiny. Governments and financial regulators struggled with how to classify and control the crypto market. Fundamental questions were: is a cryptocurrency a security, a commodity, or a completely new asset class? How will it be taxed? How will consumers and investors be protected? While countries like China completely banned crypto mining and trading, the US, EU, and other regions embarked on efforts to create complex regulatory frameworks. These regulatory battles became one of the most important factors shaping the industry's future. 2022 was an earthquake year for the crypto world. Rising interest rates and a flight from risky assets hit the crypto market hard. But the real blow came from excessive leverage and governance failures within the system itself. First, a major algorithmic stablecoin, Terra USD, and its sister token Luna collapsed. Then a large crypto hedge fund and lending firm 3 Arrows Capital failed. The domino effect brought down Celsius Network, a centralized crypto exchange and bank-like entity, and most tragically the FTX exchange run by Sam Bankman-Fried. It was revealed that FTX had used customer assets for its own risky investments and collapsed with a multi-billion-dollar shortfall. This event painfully demonstrated how the crypto world could stray from its decentralization ideals, the risks posed by trust-based intermediaries, and the dangers of a lack of regulation. This storm led to deep soul-searching within the industry. Projects with solid technological foundations, transparency, and real use cases survived, while speculative and weak projects were weeded out. The not your keys, not your coins philosophy gained importance. So what comes next? The future of cryptocurrencies appears to hinge on several critical directions. Central Bank Digital Currencies (CBDCs) China, the EU, the UK, and many others are developing their own state-backed digital currencies. Is this a victory for crypto technology, or a centralized threat increasing financial surveillance? Scalability and sustainability. Bitcoin's energy consumption is a major criticism. Ethereum transitioned in 2022 with the merge from proof-of-work to the much less energy-intensive proof-of-stake system. Layer 2 solutions promise to increase transaction speeds and lower costs. Web3 and the Metaverse. A vision of a decentralized internet imagined as a new face of the web, where users own their data and digital assets. Could cryptocurrencies and NFTs be the natural currencies of these digital economies? Regulatory clarity. The establishment of a clear, fair, global regulatory framework that doesn't stifle innovation is essential for institutional capital to enter confidently. The conclusion? The cryptocurrency story is an epic still being written. Starting as a technological innovation, it transformed into a financial asset class, a cultural movement, and a topic of global geopolitical debate. Like Rome, it is a story of brilliant achievements and deep fissures, of idealists and opportunists. Its core promise remains powerful: to democratize financial systems, reduce intermediaries, increase transparency, and expand global economic participation. Yet the path is riddled with security vulnerabilities, speculation, regulatory challenges, and the short-term ambitions of human nature. Rome built an empire in the physical world. Cryptocurrencies claim to build a new economic order in the digital realm. The first lasted 1,000 years. The second's lifespan is less than 15 so far. The outcome is uncertain, but one thing is clear. They have fundamentally altered the debate about the nature of money, property, and trust. This digital revolution is ultimately evolving not towards a question of whether code or traditional institutions will triumph, but towards a new and complex synthesis of how humanity will organize value. And it asks us this question: will the future financial system remain under the control of today's central authorities, or will those authorities yield to the mathematics of a distributed network? The answer is still being written block by block.